What we're going to talk about today is how to actually tell if a dividend is safe or not. And so, with that, we'll go ahead and dive in. So, here's the main idea we're trying to get across: a high payout ratio isn't automatically dangerous, and a low one isn't automatically safe. The number only means something once you know which payout ratio you're looking at and what kind of business is paying it. The ratio most beginners watch is earnings based, and it can hide the ratio that actually matters, which is the one we're going to focus on today, which is the free cash flow based. So, most dividend investors are taught a simple rule: payout ratio under 60% equals safe, easy, clean, and wrong often enough to hurt you. So a company can show a safe 60% ish ratio, payout ratio, and still be paying a dividend it can't actually afford. By the end, we're going to know how to spot this. So there's one simple shift that you need to make when you're doing your dividend analysis is look at free cash flow, not earnings. Plus the business model context that changes everything. We'll also give you a short checklist at the end that you can use when you're analyzing any dividend stock. So let's talk about what the payout ratio actually is. So, what are most people used to when they think about the payout ratio? So, in plain English, every dollar a business makes, the payout ratio determines how much of that goes out the door as a dividend. And the most common ratio or way of calculating it is using dividends divided by net income or earnings. And that's what most people, when you hear or see on websites, refer to as the payout ratio. It's covering the earnings. So dividends divided by net income or earnings. Here's the problem: account earnings are an accounting nomination and amortization, and they exclude the real cash a company has to spend to keep the lights on. So, paying for capex, working capital, and such. Dividends are paid in cash, not earnings. And I guess the easiest way to think about this is if you look at the two main incomes or financial statements that we're going to talk about today, you have the income statement, you have the cash flow statement. The income statement is an accounting based document. It shows the profitability of a business the company generates from its returns, or I'm sorry, from its revenues. So a company that generates 100 billion in revenue, whatever number is at the bottom, or the net earnings, or the earnings, or the net income, that's the profit that they make from selling whatever it is they sell or make, and all the costs and expenses that are associated with producing that product. Things that are included in there along the way are taxes, any interest expense payments, any debt payments, things like maybe interest income, so they earn on from investments, as well as things that are non-cash items like depreciation, amortization, stock-based compensation, etc. So all of those tell us that the income statement is an accounting document. It's not actual cash in our pockets. The cash flow statement does exactly that. It tells us exactly how much money a company has to spend on the things it needs to spend on. And an easy, I guess, analogy is to think about the income statement. The cash flow statement is like our checking account. So a cash flow statement will indicate for us personally, how much do you pay for your rent or your mortgage, for example? How much do you pay for your utilities? How much do you pay on food? How much do you pay on entertainment? The same kind of rule applies with a business. How much do they pay for inventory? Walmart has to pay a lot of money for inventory, right? How much do they pay to keep the lights on? What are their electric bills? Maybe how much money are they bringing in on contracts where they fulfill their end of the contract and they receive money? So think of Microsoft with Azure or with the Excel, the Office suite. So every time they fulfill their end of the bargain, give us access to Excel, Word, etc., we pay them and the money gets released to Microsoft. And so all those things go into the cash flow statement. And then the money that they pay out is all the expenses that they have and whatnot. So that's the cash flow statement is the money coming in and out of the business. So, a better lens to think about how to analyze how well a company can afford to pay the dividend or how safe is that dividend going forward is to look at the dividends divided by free cash flow. And free cash flow is a simple calculation. It's cash from operations minus CapEx. I'll break those down here for a second. So, cash from operations is one of the sections. The cash flow statement is broken up into three main sections. Cash from operations is generally the top of the cash flow statement. And that, again, indicates all the money that goes in and out to operate the business. So, to keep the lights on, to pay for things, to pay for the inventory that they sell, to pay for the R&D that they use to pay for the things that they build. All that stuff comes in and out of the cash flow statement. The money that's left over after the income that they generate from their revenue sales and paying all those items, that is what's cash from operations. That's the money that's left over at the end of the air quote month, if you will. And the way we figure out calculating free cash flow is we subtract CapEx or capital expenditures. You might also see it as property, plant, and equipment. It can be any of those nomenclatures or names companies are allowed to use for. It's all this basically the same thing. Capital expenditures. So those are things like paying for buildings, maybe buying new equipment, paying for computers, maybe paying for software. All those things are rolled up into CapEx. And the reason why we subtract it from the cash from operations is it tells us, okay, how much money does the company have left over now after paying for all the necessary things it needs to do to operate to invest in the business? And that could be a wide range of things. Generally, it comes down to, do they pay a dividend? Do they buy back shares? Do they maybe reinvest in the business? Maybe they have an opportunity to grow the business quicker and they want to put more money towards that. Do they pay down debt? Let's say they've used debt to make investments and they want to pay some of that down so they have more room to maybe borrow more in the future, or they want to reduce their interest expense payments. Or they might want to do companies can make. So that's one of the five. Our focus today is on dividends. So because dividends are paid in cash, we want to also make sure that those dividends that are being paid in cash are also, we're measuring that against the cash that the company generates. That makes the most sense. So, one thing I think you want to take away from is dividends are paid in cash. So let's measure them against that cash. All right. So we've talked a lot about theory and maybe some numbers and maybe how some of this works. Let's talk about an actual story. So look at a company that will give a good illustration of how the payout ratio may look on the surface like it's safe, but actually was in danger of being cut. So that company is AT&T, or ticker symbol T. So this is a company that has been around for a very, very long time. One of the original telecom companies, Ma Bell, Alexander Graham Bell, the whole story of developing the telephone and everything. This is a company that's paid a growing high yield dividend for a very, very long time. Household name. Can't imagine that the dividend would ever be cut. That this was such a rock solid business that that would never, ever possibly happen. So if you looked at the earnings payout ratio and looked at the rule, the roughly 60%, heading into 2022, by the textbook, the company looked fine. No problem. This is, easy peasy. This is definitely not a problem for the company, and they're going to continue paying the dividend, and we don't ever need to worry about that. And that's only if you looked at the earnings payout ratio, which is what most dividend investors do. And what we're going to do and how we're going to be different is if you looked at the free cash flow, there was a completely different story. So the free cash flow ran into the 140 and higher percent range going into early 2022 and during 2022. So what does that tell us? That tells us that if you look at the financial statements and you compare the dividend being paid to the free cash flow being generated, they were paying out way more cash than the business could afford. they had to plug this gap. There's no way you only have so much cash in your account, right? Before you can afford before you have to do something to change your behavior. So for us personally, if you're paying too much for your phone bill, ironically, and you can't afford that, you either have to change the phone bill or you have to figure out a way to generate more revenue. Same rule applies with businesses, and this is what was going on with AT&T is that they were paying out a dividend way more than they were generating in cash flow, and they're plugging the gap with debt. They were using debt to bridge the gap between the amount of money they had on hand to pay the dividend and paying the dividend. And the reason why they're doing this is there are several reasons, but the first one is there's nothing the market hates more than cutting a dividend. It hates whenever that happens, that is a huge red flag. And generally, companies get slaughtered whenever that happens. And because it's an indication that something's happened with the business and they can't cover the dividend. They don't have their financials are in such a disarray or in a mess that they can't afford to pay a dividend. And if they have to cut, then that's very, very bad news, either for the ongoing of the business or or other worse things. Maybe the company could be going bankrupt. I mean, those are all signals that this kind of sends. And so that's a big reason why companies are slower to start announcing paying a dividend. I'm looking at you, Berkshire Hathaway. They are very loath to do this because once they declare they're going to start paying a dividend, they have to grow the dividend and they have to continue paying the dividend. And if that ever stops, the market is going to slaughter whatever company that is. And we saw this happen with AT&T. And so the other reason why this really became a big problem for AT&T was they had made an acquisition of Time Warner Media. The company was attempting to develop another income stream. It was becoming evident to them and Verizon that the telecom boom that they had experienced earlier in the 2000s, late 2000s, early 2000s was coming to an end. And so they looked around and tried to figure out another way to develop an income stream. And so their idea was to try to become a media company. And so they acquired Time Warner Media. I don't remember the exact numbers, but it was for a lot of money, and they took on a lot of debt to take care of this. And so they were in a bit of a pickle because Time Warner Media was not generating enough cash. It was a cash suck. It was draining money out of AT&T's accounts and putting a burden and a hardship on the business because it wasn't generating enough. So they overpaid, and the business wasn't generating enough money. And so to continue to pay the debt, the idea was to continue paying the dividend, use debt to bridge the gap, and in the hopes that the acquisition would start to stand on its own, so to speak, and they would be able to pay down the debt, and this would be more of a nothing burger. Unfortunately, that did not come to pass. And what ended up happening was in 2022, AT&T saw the writing on the wall, and they had no choice, but they had to cut the dividend. They cut it 27%. They also, at the same time, spun off the Warner Media acquisition, taking a huge loss to their earnings and their income statement and their free cash flow, which all kind of melded together. They had no choice to cut the dividend, and they had to spin off this huge anchor to their business to try to get back to being able to pay a dividend, allocate capital, and operate the business normally. So if you looked at the earnings of the business across this whole period, they look safe, normal, and never warned you. You would have never seen this coming. The cash ratio, the free cash flow ratio, however, would have shown you this. If you are looking at this on a regular basis as you're analyzing the business. So the idea being that we want a whole bunch of different tools in our toolkit to analyze a business. So we're not just relying on one thing, not just focusing on ROIC or not just focusing on revenue growth or dividend yield. You want to have all these different tools in your toolkit, and this is another tool that we can use in our toolkit is along with the earnings payout ratio is looking at the free cash flow payout ratio. And the earnings ratio in this case, or the payout ratio, in this case, would have not warned you that AT&T was in trouble and that was potentially looking at a cut. The free cash flow ratio would have given you warning signs all over the place that, hey, this is in trouble. We need to consider I need to reconsider this investment, either going into it or whether I continue to own it, however that way may be. So, if you remember a few weeks ago, we talked about ROIC and how you use ROIC to help estimate growth for a business. This all kind of ties in together. And the AT&T is a capital intensive, lower return business, and so it has to invest heavily just to stay competitive, and that doesn't leave a lot of money for cash flow. And when they take on acquisitions, it increases their interest expense. So the amount of debt that they have higher debt payments, as well as whenever the debt matures, they have that higher payments in that regard. All of that bleeds away from the cash flow of the business, leaving it giving us, it doesn't give the company a lot of room to grow or a lot of room to maneuver to pay the dividend, which is why they try to stem the tide, if you will, with debt. So this AT&T is a great cautionary tale of how the payout ratio or the earnings payout ratio is not the best tool to use alone. You need to use another tool. And a great example of kind of something on the flip side would be our friends at Mastercard. So Mastercard pays a very tiny payout ratio. If you look at their if you look at their earnings payout ratio and their free cash flow payout ratio, they're both hover under 20%. So that's very, very low. And that tells us two things. Number one, it tells us that the company has plenty of room to continue growing the dividend as the company goes along. And it also tells us that the dividend is going to be very, very safe. That because they have so much room, that they're not going to run into financial difficulties. Even if they do run into some sort of financial difficulties, they still have enough room to continue paying the dividend, and we don't need to worry about that being cut. And you might look at these yields or these payout ratios and think, "Wow, that's really low." Because Mastercard's payout ratios or their dividend yield is less than 1%, 0.8% in that range. And so most dividend investors kind of ignore MasterCard simply because that yield is so low. But when you look at it in combination to the earnings ratio, the free cash flow payout ratio, and the yield, you can see that the company has a lot of room to grow. It's very, very safe. And the company is growing their dividend at 15, 20% annually and has been for a long time. And so those are strong, stable businesses. And that's another reason why we love having a company like MasterCard as part of our dividend portfolio. And when you think about a company like MasterCard or Visa or any of these companies that are lower, maybe lower yield and lower payout ratios, Microsoft, Google, Meta, these are two newer dividend payers, have very low payout ratios. And it's a feature of those businesses, not a bug. And these are very asset light, very high ROIC businesses that can reinvest dollars internally at huge returns. So keeping more of it compounds shareholder value faster than paying it out. And I want to also kind of touch on this idea that when you're looking at companies like AT&T, which had a much higher yield, a company like Mastercard, which has a much lower yield, you want to have a mix of those in your portfolio. You want to have strong, higher yield businesses because that's the cash you're going to be earning, right? But you also want to have companies that are going to grow their dividend faster over a longer period of time. Because if you're investing for 10, 15, 20 years, the company that has a lower yield but is paying out that is growing faster is going to earn you more money over the long run than a company that's paying you out, statistically dollars more, but growing much, much slower. And so that is where these kinds of companies, these fast compounders, these big compounders like a Microsoft, a Visa, a Mastercard, companies like that can be a very great addition to your dividend portfolio. You don't have to have just all high yield companies that are growing their dividends slowly. So we've talked a lot about the two stories. We talked about some theories, and I think one thing I want to kind of make sure we're kind of hammering down on is a high payout ratio is not always bad. One thing about finance or about investing is there are no absolutes. There's very few absolutes in the stock market. And this kind of idea is no different. And so, just because a company pays a higher payout ratio, either on earnings or free cash flow, does not necessarily make it bad or uh, something to be afraid of. And it also is in context. We have to think about it in context of the particular business. So let's think about this company. So Pepsi, a company I'm not super familiar with, I'll be honest, but I don't own it. But one thing to think about is recently looking through the company, I noticed that they had a free cash flow payout ratio of greater than 100%. And if I was going to be investigating this business, I would look at both ratios, the earnings payout ratio and the free cash flow payout ratio. I would also look at it in context of how long this period is. So generally anywhere from 5 to 10 years would be ideal. You can use fiscal.ai as a great tool to help you look at this. They automatically calculate the earnings payout ratio, and you can create your own free cash flow payout ratio metric, which I will show you in a future video. And the cool thing is that you can look at it over periods of time. You can split it into quarters, so you can see that maybe, okay, is this Pepsi 100% over 100% payout ratio for free cash flow? Is that a blip, or is there something structurally going on with Pepsi that would be of concern for us? And so that is why you want to look at longer periods and why you want to kind of break it down so that you can see any sort of trends that are happening. Are is the free cash flow payout ratio growing? And is if it is growing, why? Why is it growing? It all comes back to understanding the business and not just relying on one number over one period of time. You want to look at ranges to give you an idea. The other nuance of all this is that you have to look at the business model itself. So we've been talking about air quote normal companies all this time. Well, the thing I want to talk about a little bit here is companies that are maybe don't fit into this category of normal, if you will. So REITs are the first one that really springs to mind. And REITs is an acronym for, excuse me, is an acronym for real estate investment trusts. And these are real estate investments that you can make. You can buy different kinds of businesses that range from to uh, apartment complexes to data centers to public storage. There's just a vast range of different kinds of REITs that you can invest in. REITs, by the nature of their structure of their business, the way they're set up, they are required to distribute up to 90% of their taxable income uh, in dividends. And so they get a tax benefit for doing this. And so they have to do this. So if you look at a free cash flow or an earnings ratio of 90% or greater for a REIT, you may think, oh, wow, that's really high. But that's actually normal for them. And the flip side of this is that free cash flow is not really a great metric to use for REITs because of the structure of how their business operates. Uh, um, Depreciation is a huge expense for funds from operations. Again, fiscal.ai does help you with that. They do funds from operations, so you can look at that. You can also, when you read the annual reports for any of these REITs, they will include those calculations in there for you, so you can find them fairly easily. And so when we're trying to calculate air quote free cash flow payout ratio, we'd want to use funds from operations payout ratio or AFFO uh, payout ratio, and you just take that AFFO or funds from operations FFO and divide dividends by that number, and that will give you the payout ratio for their air quote funds from operations. And so that's a great way to do it. The other businesses that would be something you'd want to consider too are something like a utility. So utilities, the nature of their business is it's very structured, it's very organized, it's a monopoly, but it's also gated it's put a governor is put on how fast it can grow. So as much as we hate paying utility bills, they have to go and get approval to raise our rates. And that's usually a longer process and it takes a while. And you're very rarely going to see a REIT, a Duke Energy or a Excel Energy growing at 10, 12%. You're going to see 3, 4, 5% because that's how much they're mandated allowed to grow. But the nature of this, because they're monopolies and because they're very profitable, and because of the nature of how they manage their capital, they use a lot of debt, but you don't really look at free cash flow for those businesses because of the debt and the CapEx. It's very expensive to maintain a utility. Think about all the wiring, all the towers, all the transformers, everything that goes into a utility. It's very, very expensive to operate. That being said, they're very profitable, they're very steady, they don't grow real fast, and that's why a lot of people use them for anchors or for income for, dividend portfolios because they're very consistent. And so when you analyze a utility, you have to look at it through a different lens than you would if you're looking at AT&T or Procter& and Gamble. So that being said, when we're looking through these different businesses, I think you need to remember this: a safe threshold, there is no universal number. 60% is generally the rule, but it's going to depend, one, on which cash measure we use, whether you use earnings or free cash flow. And it's also going to depend on how stable or capital light the business is. So the last thing I want to wrap up with is I want to give you a quickie little, I guess, framework or checklist that you can use when you're going to walk through analyzing any dividend paying business. So, number one is check the free cash flow payout ratio, not just earnings. Remember, we want to use both tools as part of our toolkit. So, if the free cash flow payout ratio is way above the earnings payout ratio, let's dig in and find out why. Always ask questions. The next one, number two, is ask what kind of business is it? Is it capital intensive and low ROIC? Or is it asset light and high ROIC? Those will dictate a lot of what we should expect to see when we're looking at these different kinds of payout ratios and things of that nature. Number three, we want to use the right denominator. So when we're looking at most normal businesses, we want to use free cash flow for most. If you're looking at REITs, we want to look at FFO, or funds from operations, or AFFO, adjusted funds from operations. If you're looking at a bank, you would want to use a different number, and we'll talk about that in the future. But always make sure you're looking at the business and using the right denominator. And the last thing is watch the trend, not the snapshot. Don't look at the one headline number, look at it over a longer period of time. If we see a payout ratio creeping towards or past 100% of over the last several years, that's a red flag. We want to know why. You want to dig into understanding why. And so this all comes back to understanding the business, what kind of business model they have, and using the right tools to analyze the business as we're going through it. So that's a quick checklist you can use to help yourself with all that. All right. So the last thing I want to, I guess, wrap up with is the payout ratio isn't a number you read. It's a question you ask. Always, always, always ask questions. And we want to know, is the dividend funded by real cash from a business that can keep generating it? If you can answer that question, you're going to go a long, long ways to understanding whether a company the dividend it is paying is actually safe or not. So with that, I'll go ahead and wrap us up. I hope you enjoyed today's conversation.